I want to bring in my guests. We are joined with Warwick Powell. How you doing this evening? You doing okay?
I'm well. And what about yourself, Jamal?
I am doing okay. Dragging a little bit of ass, but I'm okay. All things being equal. Warwick Powell. He is adjunct professor in Queensland University of Technology, chairman of Smart Trade Networks Group of Companies, and president of Data Integrity and Supply Chains Association Incorporated. Powell, Warwick, you are the person I want to talk to today. In fact, you've been the person I wanted to talk to for like a week. So thank you for joining me today.
Okay.
I had the opportunity to go through your article, and just for context for the audience, on September 6th, Putin's advisor, what is his name? Anton Kobakov. In a meeting, he said this, and I want the audience to be able to see it. They're going to have to read it, but I want them to see it just to give context to why I'm bringing this up and what I'm trying to get at on this.
Сейчас пытается поменять правила на рынке золота и криптовалют. Вспомните, какой у них долг. 35 триллионов долларов. В общем-то, это два альтернативных валютному сегменту мировых рынка. Действия Вашингтона в этом направлении отчетливо демонстрируют одну из главных американских задач. Они очень хотят решить проблему снижения доверия к доллару. США, как это было и в 30-е, и в 70-е годы, будут решать свои финансовые проблемы за счет всего мира, загоняя всех куда? В криптовалютное облако. Со временем, когда часть госдолга США будет размещена в стейблкоинах, США обесценит этот долг. Еще раз простыми словами. У них сейчас валютный 35-триллионный долг, они его загоняют в крипту, в облако, обесценивают и начинают с нуля.
Now, you, Warren, was prescient because you wrote this article before this gentleman made that statement. And the article is named The Genius Act and America's Engineered Instability. I'll put it at the bottom of the video after I cut the video. Both of you seem to be making a very similar point, that Donald Trump has effectively created this stablecoin backed or associated with the US Treasury and is trying to, on some level, devalue the US dollar, or at the very least, he's arguing devalue the dollar. I think your argument was more so it will make, it's like a Ponzi scheme. It's kind of like the 2008 crash. You are creating treasury bonds on something that is fundamentally unstable in a way that the rest of the world can see it to be unstable and even comes across as somewhat desperate. I don't think your argument was that it was devaluation. Your argument was more so it will get to the point that other countries will look at the US debt as being fundamentally unstable and that they would stop, let's say, supplying products for that dollar because they would see it as being an unstable product. Give me your take on this and help me understand this, because I got to be honest, when I heard that, I was like, okay, I don't quite understand what is being said by this gentleman. I read your article. I think I understand your article, but I need a little bit of help to get there because I'm not an economist, and some of it was a little bit over my head.
To be honest with you, Jamal, most economists wouldn't understand this stuff either, because most economics actually doesn't deal with the piping of domestic or national, let alone international financial systems. Mainstream economics actually doesn't have a genuine theory of money, in truth. And so you have to look elsewhere to try to understand how the system actually works. So if we start at the foundational point, and that is this issue of the US dollar or the US bonds, the treasuries. The treasuries are issued to cover the gap between the amount of new liquidity that is injected into the economy by way of congressional funding appropriations, in other words, legal funding decisions, and the amount of liquidity that is extracted out of the system by way of taxation. So whatever the gap is covered by the issuance of of treasuries. Now, what treasuries in effect does is that it enables holders of US dollars to exchange those dollars, which are not interest bearing, for securities which are interest bearing, and thereby earn more dollars on the back of those securities that they hold. The upside historically is that those securities are liquid, which means they are as good as dollars in the sense that you can sell them whenever you need, if you need dollars for whatever purposes it is that you need dollars for, and that they have been in effect they fulfilled the role of the zero risk security within a global valuation system. So whatever it is that the US Treasuries market is doing is seen to be the zero risk base. The problem now is that by enabling the treasuries to be used as security for stable coins, you're introducing a level of instability that historically hasn't existed. And you're doing that because the stable coin is ostensibly pegged to the US dollar, but there are no guarantees that the peg holds, which means that you have an environment where the stable coin that has now been created off the back of the security, which is the treasury, may or may not hold that dollar to dollar value. And that has feedback loop effects into the function of the treasuries market as the market of zero risk or risk-free assets. And that's where it introduces significant instabilities into the global marketplace, particularly when there are large amounts of US dollars circulating in the global system. So you got to remember that when dollars come into existence and they begin to circulate, so just think of the global economy as a bunch of pipes and buckets, right? Dollars come into existence. They come into existence by virtue of decisions of Congress or by credit creation by commercial banks. So new dollars come into existence. They begin to circulate when they're used for spending purposes. And then eventually some of those dollars ends up in accounts owned by foreign entities. Because the dollars are used to buy foreign currency, which is then used to settle the imports from other countries. And so other countries' central banks now accumulate substantial amount of dollars. And what do they do with those dollars that they've accumulated? Well, they need to cycle them back into the system. Now, they can hold them as cash, of course, but holding those dollars as cash is not an interest-earning place to hold a lot of those dollars. So instead of that, they buy US treasuries because the treasuries will deliver you something as good as cash, but which is now interest bearing. Mm-hmm. And the other thing, of course, that central banks do is that they use those dollars to buy other assets, or companies that want to buy assets will then purchase US dollars with their national currency and then proceed to purchase things like stocks on the stock exchange, other financial instruments, derivatives, real estate even, et cetera, et cetera, et cetera. So it's a circulation system, and those dollars need to end up somewhere as they move around, and this is one place that they end up as a mechanism to actually manage liquidity. So the use of bonds is a way of also bleeding dollars out of the global system. Right? So it's an important liquidity management tool historically, but we're starting to see if we go down this stablecoins path, where we're going to end up is a position where an issuer of stablecoins uses US dollars to buy treasuries, then uses those treasuries as security to issue new stablecoins, and then uses those stablecoins to buy more treasuries, and away we go. So it does create a liquidity cycle for treasuries. So we're starting to get that circulation effect, but it increasingly has less and less to do with what I guess I would call the real economy. So the economy of services and goods production, and the intensification of the circulation of fictitious capital and money, US dollars, chasing other digital assets, will, of course, lead to, well, actually, it'll lead to a further absorption of money capital into the financial markets, as opposed to seeing that money capital mobilized to support things like building new factories, installing new equipment, buying new equipment, training people, and actually leading to something of a redevelopment of a manufacturing base in North America.
So I just want to make sure I understand this. So someone buys a stablecoin. That stablecoin is pegged to $1 under the treasury. Meaning, am I getting this right? The moment
it should be, but there's actually no guarantees. And over the last couple of years, the stable coins that have been issued have experienced many occasions where they've lost the peg. Right, so they've dropped to 99 cents and things like that. So that doesn't sound like a lot, but when you're talking billions of dollars, those little slippages are actually quite significant. So the extent to which the stable coin is consistently and always equal to $1, that's not a guarantee, and that's part of the reason why the introduction of stable coins as what is in effect a derivative on top of a security creates risks in the global financial system.
So it's not, just so I'm clear, it's not someone buys a stable coin and the stable coin automatically goes to treasury. It's more so that the stable coin is supposed to be pegged to the dollar in the context of.
So what happens is that institutions that have dollars can then buy treasuries and then use those treasuries as security for the issuance of stable coins. So treasuries are sitting still, if you will. Now the issue is that when there's another set of issues. So treasuries are time limited securities, right? So they mature. Whether they're short, medium, or long-term treasuries. So at some point, those treasuries mature, and the holders of them need to come good with the dollar, the original amount paid for the treasury. When you've got a system where you're starting to create many layers of separation between the security and its subsequent derivatives, or derivatives that ultimately rely upon the foundational security, you're creating intensified risks, because you can get a misalignment between the timing of maturation and the fact that a stable coin is not time limited. So a stable coin, once it's given life, is as good as a dollar, so long as it remains pegged to the dollar, and it is out in the wild. It's been injected into the economic system, into circulation, and in fact it could, I think, be used to purchase more treasuries, which then enables another round of stable coins to be created as well. So it's a layered cake that sort of feeds on itself. I wrote a much longer article about all of this on Substack, which had an image of the Ouroboros, which is the mythical snake eating itself, and in a sense, that's sort of where we're getting to.
That is okay. So, I know what I see where my misunderstanding is.
Let me try and describe it this way, Jamal. It is the problem with finance is that, in a sense, it's entirely abstract, right? So it's like having a security, something that backs whatever it is that you're making a promise on, and then you start writing new IOUs, and then you use those IOUs as security to then write other IOUs.
I see.
So eventually, we've got a bunch of IOUs stacked up on each other, with somebody holding some IOU down the track, hoping that or believing that it's a very stable IOU, because you'll be able to redeem that for whatever the IOU was for. But as you get further and further away from the foundational security, the the risks that these IOUs can't be redeemed, can't be made good, is that it actually increases over time. And we saw an example of that in 2007, 2008, with the progressive explosion of derivatives and associated instruments that ultimately couldn't come good because to put it very simply, there was way too many of them out there making claims on reality, and reality just simply didn't have the productive capacity to meet the obligations that was being placed upon it. So, this is sort of the risk that this particular approach to stablecoins faces.
So you can get a situation where the stablecoin goes to 95 cents on the dollar. Someone, or let's say a group of people, countries even, have invested trillions, or even let's say hundreds of billions of dollars into it. And that 5% differential could be catastrophic to the way the system operates. Am I getting that right?
Yeah, well, it could be. It creates, again, it creates instabilities when these systems need to be stable, particularly if they're being used to settle cross-border transactions and price cross-border transactions. And so in the article that you showed before, my basic argument is that I don't have an issue with the technology per se at all. In fact, I think that there are many potential good uses of this kind of technology. The issue is the institutional framework that brings these technologies to the table and then enables them to create certain kinds of things. And the Genius Act, I think, is hyper-financialized and creates more risks than it solves problems. And if you were in the global south, for example, this is another reason to run a million miles and divest yourself from US dollars to the extent that you can. And I say to the extent that you can because many countries still have debt obligations denominated in dollars, which means they need to have ways of servicing those loans. And many of them also need dollars to undertake other kinds of transactions, right? But a structured, strategic plan is necessary for global south countries in particular to wean themselves off the dollar system. And the main reason for that, on top of the weaponization that's taken place already in the last decade or so, is to manage your exposure to the kinds of risks that I think this new system is likely to give rise to. Fortunately, we are seeing some of those institutions being built, whether it's the SCO Development Bank, the ongoing expansion of the new development bank under the umbrella of BRICS, etc.
Do you see this as, do you agree with Kobakov with this idea of that this is some kind of scheme to devalue the dollar? I've heard other economists make this case also, that the United States under no circumstances would ever be able to pay back the 37 trillion. And by the way, that's going to go higher, especially after the midterms. And so we might be looking at $40 trillion in very short time. Do you think that
there are two issues here? The first one is this question of liquidity. So the United States is not going to run out of dollars, period. It can, because it creates the dollars. So in that sense, it can always pay back maturing treasuries. That is actually not the issue, right? So if people think that the nation is going to go broke, they're in a sense barking up the wrong tree. That's not to say that there aren't major problems in this particular system of money creation. And the problems come from the fact that it actually reinforces systemic instabilities and inequalities by the way that it rewards wealthy institutions by enabling them to essentially hold their wealth in bonds and be rewarded for that. And so what you see over time, because it's not an ordinary person on the street who owns bonds, right, earning interest. Right. The institutions that own bonds are, banking institutions, retirement funds, mutual funds, and those sorts of things, as well as organizations that essentially act on behalf of high net worth individuals. And so this is a system that reinforces the widening wealth gap in the United States. Now, we see that in many different aspects, and the foundational evidence of that is in the concentration of ownership of capital, whether it's by way of ownership of shares on the stock exchange, where, according to the Fed, 93% of market capitalization value in the United States is actually owned by 10% of Americans, and half of that is actually owned by the top 1%. There's a bunch of data which shows over the last 40 years that the ownership of capital across industries, from manufacturing through to services, et cetera, has progressively concentrated, where something like 70 to 80% of capital is actually owned by 5 to 15% of capitalists. And so we've got a system here that actually has built in acceleration of systemic instability by way of suppressing wages of the vast majority of Americans and boosting the asset wealth of a very small number of Americans.
Wow. Yeah. One of the arguments that you made in the article was that one of the problems with this particular system is that the US will have a ton of liquidity, meaning they will have dollars coming out of the yin yang, but they wouldn't necessarily be able to buy anything with those dollars when countries start to effectively explain that part, because I was fascinated by that part.
So if you hold dollars, and dollars, of course, are useful in the United States. That's where dollars are most useful, because they are the legal tender, and if you hold dollars, you can exchange them for all sorts of things. So holders of dollars, and when there is significant liquidity in the system, and as I mentioned, the distribution of those holdings is very concentrated. So what do wealthy people do? Well, wealthy people don't go down the street and spend money at restaurants much more than anyone else. They obviously spend more per capita, but they still only go out, so many times a week. What they do is that they accumulate capital assets and financial assets, and the evidence of that clearly is inflation in asset valuations. And you see a very strong correlation between system liquidity, for instance, measured by M2, money supply growth, and the trajectory of valuations and market capitalization of the New York Stock Exchange or the S&P 500. We see very tight correlations between system liquidity changes and property values, especially a correlation between the rate of acceleration of credit growth. So it's not just the rate of credit growth, it's whether the rate of credit growth is accelerating or not. And if it's accelerating, that feeds into asset valuation growth or asset inflation in housing. So these are the kinds of dynamics that are set off once you have this sort of system liquidity that hasn't been reined back in. So one of the reasons why taxation exists is actually to enable financial authorities or governments to seek to manage system liquidity. Often people say that when there's lots of money chasing too few goods, of course they say inflation occurs, but that sort of line, in a sense, masks a number of very different kinds of inflation. So I described asset inflation, which is a lot of system liquidity chasing a relatively small number of capital assets. But other kinds of inflation, such as inflation for food, that's actually not because there's too much money chasing food. It's because food systems have been fundamentally disrupted, and you have a concentration of ownership in food systems, so that supply chain power enables certain sections of the supply chain to increase prices. So there are different kinds of drivers to price rises within capitalism, and the monetary circuits tend to actually drive asset valuation far more than they drive inflation in goods in particular.
I thought that the purpose of the stablecoin or attaching it to the treasury, I mean, short of Donald Trump's kids being invested heavily in it and getting a huge amount of $2 billion from Gulf states, but that's a whole different corruption scheme that Trump is running with us. But I thought part of the argument was that by attaching it to the treasury, that it would make it stable, and which is why they use the propagandistic term stablecoin. Is that not true? What would create a situation where it becomes unpegged to the dollar?
Well, attaching it to the dollar is what's meant to make it stable, not to a treasury note, because you've got to remember the treasury note's value fluctuates,
Right.
and it fluctuates against the dollar. So the idea, in theory, is that a treasury is a solid security, and therefore is and it's liquid. So it's a useful counterpart to have as a reserve when somebody issues stablecoins. So if you in the old days, so in the years immediately after the Second World War, and I'll use a case of the UK. Or was it just? It was during the war. The UK Treasury actually issued its own note, a Treasury note, and it was they thought it would be less than the Bank of England note, and it was printed on much worse paper. It didn't look as pretty. It certainly was a lot smaller. All those things. But the market was willing to accept that the Treasury note was as good as a Bank of England note because of the backing of the Treasury. Now, that's the theory, of course, behind using treasuries as the foundation point for these stable coins. But you do wonder why you need to use a treasury as security for a stable coin and not just the dollar itself, right? And introducing this intermediating, time-constrained security that is traded in its own right. Creates a level of complexity and risk, I think, that doesn't actually aid the stablecoin story. Stablecoins already, as I mentioned, have had episodes of decoupling from the dollar, and I don't think any of this makes the situation any better. So in a sense, the administration was forced into this position because of the public debate in North America concerning central bank digital currencies and the issues around privacy that approach gives rise to. And in the lead up to last November's election, President Trump, whilst as a candidate, essentially came onto the side of those who oppose central bank digital currencies. But the minute he did that, the risk was leaving the United States languishing from a technology or a financial technology point of view. And the alternative then was to become a stablecoins advocate. So, you know, in some respects, the politics of CBDC privacy in 2023, 2024 laid the groundwork for this particular decision.
Speculate for me. Where do you think this goes? I mean, for one, do you think other countries are going to invest in something like this? Or do you think that the other countries are going to look at this as you described in your article, desperation by the US, in which case they're going to be more likely to pull out of treasuries or stop investing in treasuries?
Look, it makes countries more wary, and it will, I think, reinforce or consolidate the view of central banks across the world that they need to diversify their portfolios more than they have historically, and certainly in the last 20 to 30 years. So I think this consolidates many of the reasons that have underpinned central bank diversification, and we are going to see a continuation of this process of currency multipolarity that has been unfolding for a while now, but has really picked up a head of steam in the last couple of years.
Mm-hmm. So it sounds like you're saying de-dollarization.
To an extent, but you know, there's a lot of dollars in the system, and the United States economy is still an important economy in the world, and American citizens doing business in the United States will still use dollars. So until all these dollars, in a sense, get bled out of the system, you know, they are in the system somewhere. So when people talk about so-and-so, quote, dumping treasuries, unquote, there are two possible things that are happening, actually. The first one is that they're simply not refinancing into new treasuries when old ones expire through maturation. That's one. I wouldn't quite call that dumping, but they're certainly not renewing their commitment to that particular asset. And the second thing that may be happening is that there is a modest amount of selling, but But we can see that the prices of treasuries really hasn't behaved in ways that you'd think would be the case if somebody like a Chinese central bank was, quote, dumping them on the market. Now, of course, bear in mind that when these instruments are sold, someone else owns them. Right? So selling treasuries means you get dollars, because that's what you're doing. You are exchanging your treasuries for US dollars. So you're not really ditching the dollar per se. What you're doing is converting your US dollar denominated holdings from a treasury bond back into US dollars, which you then may use to purchase gold or whatever it happens to be. But don't forget that whoever sold you the gold now has the dollars. So the dollars don't disappear out of the system. The only time they disappear out of the system is when they're taxed out of the system. Right? They temporarily are withdrawn from circulation when they're swapped for treasuries, but until they're taxed, these dollars are floating around in the global system somewhere. They might not be in circulation. They might be, in effect, sitting dormant in accounts, but they are still out there in the wild, in the global network.
Oh, so they don't vanish. They're always there.
Until they're taxed out of existence, they don't vanish. The other way that they disappear is when people pay their loans back. So that's the other way that dollars are taken out of the system.
But even then, somebody has them. I mean,
no, they're basically gone because, well, remember, it's a cycle. So the system's producing new dollars as it takes dollars out.
Right. Okay. I guess I was thinking in terms of if I owed you $1 million, which I don't have, but let's say at some point I get $1 million and I pay you the $1 million, you're holding on to the $1 million.
Well, if it's private exchange, the dollars still exist in the system. If you pay the bank back because the bank created that money for you, that money is taken out of the system.
Right. Because what do they call it? Fragmental currency. Effectively, the banks make money out of thin air of sorts.
Yes. So they make adjustments on your ledger, they credit your account, and then eventually, as you pay the money back, the money is withdrawn from circulation in effect.
If you think that the U.S., or if your point of view is that the U.S. was kind of forced into this position, why do you call it desperate?
Well, because I think that they're scrambling now to generate circuits of demand for treasury notes, because demand for treasuries is a bit flat, and other countries are taking a step back a bit. They're struggling with the auctions, and so creating another use for treasuries to enable private institutions now to issue quasi dollars, if you will, or dollar-based promissory notes or bank checks is a way in which demand for treasuries, particularly from the domestic market, can be generated.
Is any other country doing this? Anything similar to this?
Hong Kong has introduced some laws concerning stablecoins, but Hong Kong's laws are much more conservative in a sense. They actually require dollars, either US dollars, Hong Kong dollars, or RMB to literally be held in escrow. So that's Hong Kong's approach. So that when someone comes back to you with a stable coin that says, give me a US dollar, there is a US dollar to give them. So Hong Kong's approach is quite different.
One last question on this. Nothing is backing the dollar. So how does an instrument that is being effectively conjured out of thin air, backed by something that's conjured out of thin air? That part, I don't quite get that part either. It's not like the dollar is backed by gold or the dollar is backed by something else. It's effectively backed by oil, and oil being appropriated in dollars. But that's not entirely even true now. So Saudi Arabia has yuans that it would allow. So
this question of backing is an interesting one, right? So what do we mean by that? What we really mean by that is how confident that we can exchange dollars for something else in a relatively consistent way, and have confidence that we can do that at some point in the undefined future. Right. That's really all it is. And so in an ideal world, I know that for a given unit of monetary account, $1, which I can exchange for 1 unit of X today, that in 6 months' time, I can be reasonably confident that I'll get 1 unit of X in 6 months' time. And in 12 months' time, it'll be close to 1 unit of X as well. Now, interestingly, inflation is actually not a bad thing, so long as it's not too high. Because your problem in economic systems is that if we have, if currency in effect is existing in a deflationary environment where you can actually buy more with it tomorrow, your incentive is actually to hold it today and not spend it. And economic systems actually rely upon circulation. Right? So if everybody stops spending, the system grinds to a halt. So modest amounts of inflation actually aren't bad things for monetary systems, because that takes away the incentive to hold today with a view to spend tomorrow. So look, that's sort of how these systems kind of work. And the problem with the US dollar, in a sense, is that the US doesn't produce things, services, or goods, material goods, that the rest of the world can't get elsewhere, by and large. And if the US is unreliable, undependable, fickle, capricious, or whatever it is, in other words, just unstable and difficult to deal with, you then start to think to yourself, well, look, I'll get my oil from someone else, or I'll get my machines from someone else. And so the backing, in a sense, comes from the institutions of the state. The extent to which the state ultimately will enforce the IOU, because it is just an IOU, but the backing is the fact that it is an enforceable IOU.
One last question, I'm sorry. Okay. Would the U.S. ever pay this money back, the $37 trillion, which is going to go up even higher after the election, after the midterms?
Well, the system, in a sense, by virtue of its very nature, means that it will largely increase. And the reason it increases is because the system needs net monetary growth for capital accumulation to take place. So this is how capitalism works. The system requires credit to be created and injected, new liquidity, so more liquidity in the system today than there was yesterday, to be able to finance the production of things, and the circulation of goods and services, the repayment of interest, etc., etc. And so the system, by design, necessitates what is in effect a continued growth in liquidity. Now, as liquidity growth is governed and managed imperfectly, because it's hard to know exactly how much liquidity is in the system on any given day, right, we get some fluctuations. But efforts to pay the debt back will actually see that amount of money taken out of the system. So if you were to repay $37 trillion tomorrow, in effect, you are engaging in a massive systemic liquidity management exercise, which has massive implications for the system.
You're sucking that money out of the economy, basically.
Yeah. Because you pay it back. Because you pay it back with taxation.
I know, but that means we're going to be $100 trillion in debt at some point.
Yeah. So the system needs dollars being created. As dollars get destroyed or taken out of circulation, new dollars have to go into the system. If you paid it all back, and you paid that back by taxing, you've literally withdrawn all that liquidity from the system.
I know, but Warwick, that means that we're going to be at $100 trillion.
Yeah,
like it's inevitable under that model.
Yeah. So again, as I said, liquidity isn't the issue, because you can keep doing this, because these are literally legally enforceable IOUs. The problem is the way the circulation system works, that distorts, if you will, the distribution of wealth. And the consequences of the distribution of wealth is actually what destabilizes the system. So my argument is that as wealth disparities grow, and as capital ownership continues to be held in smaller and smaller hands, that households are under more and more pressure, their real incomes don't grow, household debts increase, We've seen data in the last 24 hours showing that I think some 48% of American consumption expenditure comes from the top 10% of households. At some point, a system that looks like that is a system that has a lot of increasingly desperate people who may get very, very angry. And now what happens? And we talked about this last time, right? What happens in that tinderbox? Well, I don't know. But there are some interesting things that sort of perhaps paint a picture. So something that I noticed last year that's been growing in demand, an incredible rate of growth, is bulletproof glass. Bulletproof glass is projected now to grow at a compounded annual growth rate, sales of bulletproof glass at somewhere of a 9-point-something% per annum compounded. I mean, this is huge. Really? Now, I think we both know that it's not poor people buying bulletproof glass.
No.
So these are sort of symptoms of a systemic problem that has seen financialization drive wealth inequalities to a point where households aren't even experiencing modest real income growth. They're actually experiencing zero real income growth, and some of them are actually going backwards. Because one of the interesting things when you start to look at the inflation numbers for different types of things, you find that services, for example, are going through the roof. They're costing a fortune. Health, education. Now, what does that do in the end? Well, poor people will die earlier, and poor people won't get an education. So it reinforces the fundamental reasons why people don't have social mobility. No education, bad health.
This is happening in all of Western governments. I mean, where the debt seems to just be inexorably going up.
Well, it's not the fact that it's going up per se, it's how it circulates in certain parts of the system. Right. So, as I said, liquidity isn't the thing to worry about per se. You can always find the money because you produce it. That's not the worry. The worry is what I've just described. Right. How it totally sends the system in a inequitable spiral, and all systems, and capitalism in particular, are unequal by design or by institutional history. But when you actually start seeing the disparity grow, and poor people actually getting poorer, not just relatively poorer compared to the wealthy people, but in absolute terms getting poorer, then you start having some real problems. If you drive around parts of the United States and go through some of the smaller towns and cities, they're dead. They're totally dead. I watched a documentary night before last about the history of Atlantic City. I mean, it had a glorious history once, and it tried to refashion itself as an East Coast casino city, failed, and now it's a nothing. Right? It's got real all the problems of urban decay. This is what's going on now. What happened now after the financial crisis? Well, as people couldn't pay their mortgages, they walked away. Right. So in the US, there's non-recourse loans. They just walked away. Who bought all these things up? For the first time ever, hedge funds and private equity funds got into residential property. BlackRock is the substantial landlord now in America. It wasn't before 2007. And once you've got hedge funds now controlling the housing stock, rents will be priced in a way that makes their shareholders what they want, but it will, again, reinforce and consolidate the systemic problems that have been bubbling away now for many decades.
Warwick, I always get a lesson from you, and I always appreciate that lesson. And I hope the audience does also. This is a fantastic breakdown. Thank you for this. Warwick Powell, adjunct professor of Queensland University of Technology, chairman of Smart Trade Networks Group of Companies, and president of Data Integrity and Supply Chain Association Incorporated. You are fantastic. Thank you for this. I really appreciate it.
Pleasure to be with you again, Jamal.
Have a good one. Thank you.